Considering it is 12:01 and we're starting to get to some more stable numbers on the participant side, we'll get going. Thank you so much for joining this First Street webinar. My name is Matthew Eby, and I'm the CEO here at First Street. And with me today is Dr. Jeremy Porter, our head of climate implications, and he and his lovely team are the ones that have put together our 12th national risk assessment, property prices in peril, where we look at the macroeconomic variables that are impacting properties today, be it commercial or residential, and what those are as an instance of insurance pricing increases, insurance shocks, or the actual changes in population. So climate migration is a term that a lot of people use, but where are we seeing people move from and to? So we have a lovely set of slides that we'll go through, a couple housekeeping items. We are recording this, and so we will be sending it out to the same distribution lists that you probably heard about this webinar from, so you can access it there if you want this again, which you'll be able to see the slides and everything through that. If you want to reach us, you can email us at info@firststreet.org. We'll cover that again at the end. And if you have any questions, the most important part, please drop questions into the chat. We will be answering them as we go. We'll bring them up. If we see a bunch of the same ones, then I'll interject and ask Jeremy some questions. But that's pretty much it. We'll go from 12 or 9 a.m. if you're on the West Coast. We'll go for the full hour. We'll stop there. And I'm excited to hear from Jeremy and from all of you. So please drop the questions in. And with that, Dr. Porter, if you wouldn't mind taking it away and educating us all a little bit on your latest peer-reviewed research and the report.
I was on mute. I was trying not to make
I was about to say, Jeremy, I was just about to say, this is going to be the classic joke. And, I think you're on mute. So take it away, my friend. Take it away.
All right. Take two. So thanks for introducing the report. I think the team and I, Jasmina Baresh, Zachary Hirsch, Danielle Magisi, we're all really excited to present this report. This is sort of the core work that our team works on in terms of the downstream climate implications, the social, the economic impacts of climate exposure. So we're really excited about this report. I'll walk through the slides, present out the results. We do have people that are responding to questions as they come in. There's a lot of people on the call, so we'll try to get to as many as we can, and then we'll compile the ones that we don't get to, and we'll respond to them later. We always start off these types of presentations by talking about sort of a framing around the issue. We all know that real estate is a huge component of the American economy, and we've started off the slide by saying it's the cornerstone of the American economy. You can see the amount of money that's wrapped up in both the residential and the real estate world. Also, we can see about 65% of U.S. homeowners or U.S. adults are homeowners. So not only is there a huge amount of money in the real estate space, but also a huge amount or a huge proportion of the population participates directly in home ownership. And why that's important is because home ownership has been the primary way that wealth creation has been created across the U.S. So in our own analysis, looking at data moving back to 2000, we can see that both in terms of inflation adjusted increases and nominal growth of real estate, we've seen real increases in the valuation of homes and the property value at large, even in the face of the recession that we saw back in 2008. So it is something that's been a reliable way for folks in the U.S. to build wealth. And so as we started to build out our model and started to think about the ways in which property value changes, property value increases, a lot of that's driven by location desirability, residential preferences. So we went back and actually worked through a series of models that start to look a lot like a series of hedonic models, where we're really modeling amenities and disamenities associated with location desirability, where the outcome variable that we're modeling is change in population. So we're really focused on understanding over a period of time historically, how are all of these different indicators related to change in population? What do we see in the historic record? And how can we sort of understand these primary two components in terms of quality of life and cost of living as they intersect in terms of understanding location desirability? Historically, we know that a lot of folks have moved from the north to the south. That's been the predominant macro migration pattern that we've seen across the US. The fastest growing states since 2000 have been California, Texas, and Florida. It's probably not a surprise to anyone. Over that same time period, we've seen the largest amounts of dollar damages from the billion-dollar disasters data, also in California, Texas, and Florida. Part of that's because we've seen increased exposure to climate hazards. They're becoming more frequent, they're becoming more severe in some cases, but it also has to do with the fact that people are moving to these areas. There are just more assets, there's more properties, there's more to be damaged, there's more infrastructure in these spaces. And sort of the intersection of those two patterns that drive up the risk that we're seeing. But ultimately what it does is set the stage for concerns that we have ourselves around the increased environmental exposures and the cost of living per increased insurance. And one point I want to make before we get to that is that when we think about population movement, that last slide really showed state level population trends, very high level macro population trends. Rust Belt to Sun Belt is the way it's oftentimes referred to historically. What we found both in our proof of concept climate migration paper back in 2023 that just focused on flood, and then our multi-hazard model that we published building off of that last year, is that to understand how people are making climate informed decisions, you really have to focus within states. You have to focus within markets and understand how people are thinking about sort of the relative risk to these different climate hazards, while thinking about, staying at the same job, staying close to their family, their kids staying in the same schools. And all of those things together mean that we really need to look at population change at a high resolution to actually dig down and find the patterns that show that people are responding to climate exposure.
And on this one, Jeremy, I think it would be helpful because I know when you explain these things to me, it's always really helpful to talk about the granularity of them, because this map obviously shows the entire United States, but at the top you say census tract level population change. So very granular, but very big map. So if you wouldn't mind heading on, like, what, for some people, I'm sure the question is, what is a census tract, but just what does that represent? And then how can you differentiate the absolute population change from that?
Yeah, so there's a really good question. So we study population change at a lot of different levels. There are tools that the Census Bureau, for instance, puts together at the county level, county to county migration patterns and things like that. What we ended up doing was digging down even a level lower than that and focusing on census tracts. There's over 80,000 census tracts across the US, if it gives you an idea of how many of these things exist across the country. They tend to have populations, on average somewhere in 1,600 folks or something like that. So they start to approximate neighborhoods. And when you think about census tracts approximating neighborhoods, all of the qualities that come with neighborhoods are associated with that. The desirability of living in certain neighborhoods, the schools that exist in certain neighborhoods, restaurants, bars, job opportunities, all these different things that exist in certain communities can be tracked when we start to think about looking at populations at that hyper-local resolution, as opposed to bringing it up to a higher level of resolution where all of that stuff gets diluted. So really we're focused on those high resolution indicators. And I think it's a good segue into the next slide, because really in all of those different communities, the 80,000+ communities, we're looking at things like access to transportation, access to healthcare, school quality, employment opportunity, some of the cost of living metrics that we have at a local level. But from this slide in particular, you can tell that a couple of the things that we're really interested in as we kind of walk through these setup slides are the environmental conditions, and in particular, the increased exposure to climate hazards as we're seeing more frequent, more severe weather disasters, and then increasing insurance costs, which are directly related to one another. But those increased insurance costs are directly impacting the cost of living. So there's this quality of life metric that's being directly impacted by climate exposure, and then the insurance costs are also increasing as a response to that exposure. So just nail down a couple more slides that frame the research that we've done, just to highlight the fact that Americans are paying more for insurance. We went back and looked at the consumer expenditure survey from the Bureau of Labor Statistics, and ultimately we found that from about 2000 out to about 2015, your average American was paying less than 10% of their mortgage, which was associated with their insurance cost. After 2015, we've seen that increase to almost 23%. So we're getting to the point now where we can say, by looking at the data, that Americans are paying more money for insurance. It's in the historic record attached to mortgages, and it means that the cost of home ownership is going up on average for your average American that has a mortgage. The reason why that's important is because in general,
Jeremy,
yeah.
when you go back to, just to interject, because I think it's important, is when we say homeowners insurance, are we talking about homeowners insurance and flood insurance, so all insurance that you're paying, or is this 66% increase, or this rapid increase that happens around 2017, just a measure of just homeowners without the inclusion of flood?
Yeah, it's important because we're looking at homeowners insurance premium as an HO3 policy, which is your traditional homeowners insurance policy for places like Florida, for places like Southern Louisiana, for places that are in these special flood hazard area floodplains. They're going to have the additional cost burden of an NFIP policy for their flood risk also, which we also know has increased in recent years due to changes in the NFIP pricing algorithms.
Wonderful. Well, not wonderful, but helpful clarification. Thank you, sir.
Yeah. And so why is that important? Well, it's important because when you look at the combined ratio, which is the amount of payouts that an insurance company makes, coupled with the overhead, sort of the cost of running an insurance company, and you compare that to the actual premiums that an insurance company brings in, generally, landing at about this 10% profit point means that insurance companies are doing pretty good. And up through about 2016, in this data set, we actually see that they're landing on that profit point. Insurance companies are making about 10% profit, which means they were bringing in more than they were paying out, plus paying to cover the cost of doing business. Since about 2017, though, we've seen insurance companies are actually paying out more than they're bringing in. So ultimately, what we're seeing is that combined ratio in 2023 is up to 110.5%. In the simplest form, it means they're paying out 10.5% more than they're bringing in, plus the paying out also includes overhead, but essentially they're losing money and they're not making a profit. When you take those 2 points together, the biggest takeaway from these 2 slides is that homeowners are paying more through their insurance policies, and as a percentage of their mortgage, we can see that clearly, and insurance companies are losing more. That pattern moving into the future essentially means that we can expect for insurance costs to continue to increase. So what we've done is we've taken our average annual loss estimates and projected out change in insurance from today out 30 years into the future. And the average annual loss is essentially the expectation or the expected loss that a home could have in terms of damages, given the risk profile of that property. I always use the example, if you're in a 1 in 100 year floodplain and the damages from a 1 in 100 year flood would be $100,000, the insurance companies would divide that 100,000 by 100 or get it down to 1%, so that they knew how much to charge you annually in given your risk profile, so that you could pay for the flood damages if they were to occur. Ultimately, if you take that number today and you take that number into the future, it gives you the ability to scale insurance costs into the future. So what we're showing by looking at those average annual loss expectations scaled into the future is that in Sacramento, we could see as much as 137% increase in AAL due to wildfire risk. In places like New Orleans, from flood risk and hurricane risk, you could see as much as 196%. And again, this is a good point that Matt made earlier. Focusing on the climate hazards that impact homeowners insurance specifically is important in this case. So we're really focused on wind, wildfire, in wind, wildfire, and hail in the home insurance rates, and then flood, we actually have another model for to project that out to the future.
So, Chairman, just to replay these three slides back to you, you're saying that, and I think it's really important because it's just so dramatic, that we've gone from 7 to 8% of the normal mortgage payment is to cover insurance for a home. That's increased to going over 20% of a normal mortgage payment for someone. So, you're encroaching on a quarter of the cost is to insurance, which is all money you don't get back. It's just a sunk cost. It's not going to the appreciation of your home. So that value is being eroded. And then on top of that, you're then saying, but even with those increases across the board, insurance companies are still losing 10.5% on average, which is not sustainable in any way, and is reflective of what we're seeing in the insurance market in certain states where people are backing out. They're saying we can't operate under these conditions unless we're able to charge an actuarially sound rate. And so with that, if we just take these two slides together and think about it for a second, it means we're already at bridging a quarter of our costs are insurance, and they're not high enough. So we know they're going to increase, and they haven't been high enough for a number of years. So they're going to dramatically increase just with the current risk. But then you're telling us more worse news, where on the next slide, we're then saying, well, that's true. And even if you were at an actuarially sound rate today, it's still going to increase by, up to 4x in some areas, which is just so astounding to think about the trajectory we're on and the trajectory we're going to continue on across the country.
Yeah, that's a good point. I mean, we have seen for the last 5, 6, 7 years a response from the insurance industry to the increased exposure, the increased payouts associated with climate damages. These climate models are driving a lot of that, or they at least illustrate what's driving a lot of those increases in cost. If we take those metrics, continue to predict out 30 years, we're getting to the point to where we can start to understand, at least from a climate component, what the additional cost of insurance is going to be. There'll be other indicators that may also drive up insurance, but if we just isolate the climate component, we're able to understand how much more important climate is going to be in terms of pricing damages into the future. It's a really important point, again, that you made earlier around differentiating between homeowners insurance and flood insurance, because a lot of what we're seeing in the media and when talking about the insurance issue is focused on homeowners insurance, and we know that's an issue. We know that the ability to price risk and properly so that climate hazards can be covered is driving up the insurance costs. But there's also been a recent change to the pricing algorithm for flood, which was called Risk Rating 2.0, which is the NFIP's National Flood Insurance Program policy, where prices in some areas, like in southern Louisiana, for instance, Plaquemines Parish, rose by about almost 800% over that time period. So there is a correction to make the National Flood Insurance Program more actuarially sound at the same time that we're seeing these increases in the home insurance program.
And with that, Jeremy, I think I might just replay what you're saying to make sure everyone understands the difference between these two, which is you heard Dr. Sorry, Jeremy, you heard I lost my video there. You heard Dr. Porter talk about HO3 policies, which are the homeowners policies. So what do they actually cover? They cover damages from hurricane winds. They cover damages from hail. They cover damage from wildfire, but they are not inclusive of flood. And so those HO3 homeowners policies, then if you're in a FEMA flood zone, not only are you seeing those increases, you have to buy flood insurance. And those flood insurance increases are then additional on top. So you have this ever increasing, approaching 25% we were talking about, all the signals that's going higher. And then for a subset of properties, they're mandated to buy flood insurance, which are then this additional tax on top of that, given the risk that they're seeing from flood risk today and that increasing climate risk associated with increasing flood costs, which you're showing or you're talking about. So it's this duality of increasing prices that you see across the board for certain properties or certain commercial institutions or businesses or whatever it might be.
Yeah, many parts of the country are being impacted by increasing homeowners insurance. Kind of hidden in that is the fact that many parts of the country are also being impacted by increasing flood insurance costs, and in some places that compounding impact can be a tremendous amount of increased cost of homeownership. And so what we've done is actually taken our NFIP risk rating 2.0 projections that came from FEMA, and ultimately we've taken that data and scaled it out with our flood average annual loss, or our flood AAL, to highlight where we're likely to see the largest increases in flood insurance moving into the future. Again, remember that the NFIP now is using a risk-based model underlying its NFIP pricing algorithm. So what we're showing here are increases on top of that in terms of additional cost of flood insurance. And, you know, some spots pop out. Broward County pops out as 122% increase over the next 30 years. Jefferson County, New Orleans, Louisiana, actually goes up 533%, where we've already seen parts of southern Louisiana go up by as much as 800%, given the last risk rating 2.0 adjustment. So some of these increases in Louisiana are getting to the point where flood insurance is just going to become more and more difficult for a homeowner to shoulder as a cost of homeownership. The other thing I'll point out while we're on this slide is the Mid-Atlantic, in particular, our Chief Science Officer, Dr. Ed Kearns, Dr. Jim Cawson, Dr. Carrie Emanuel, the folks that we work with in the space of synthetic hurricane tracks will tell you, and they'll talk to you about it. We actually have a webinar on it if you want to go search for it. But they'll talk to you about the poleward movement of hurricanes, and the fact that over the next 30 years, we're likely to see more hurricanes move into the Mid-Atlantic and move further northward. And that's going to cause additional increases in cost and insurance in that space. So sort of taken together, we have sort of the recipe here where insurance is increasing. We're already seeing it in the historic record. Insurance companies are likely to continue to drive up insurance costs to become solvent, and actually to become actuarially sound. And then we're already starting to see, if we project that into the future, that those are only going to continue to increase. And what we've done at this point is integrated a lot of our own data into places like Zillow, Redfin, Realtor.com, Homes.com, with the goal of informing consumers, giving people information around their climate risk. And then, as you can see on one of these integrations, as you go in and you look at your flood risk, or you look at your wind risk, we're flagging things like insurance information, so people understand, not only do I have risk, but this could potentially impact the cost of homeownership. I need to take a deep look at this and understand what it's going to cost me moving into the future. And so as you have that information available for the first time, people are looking at this data as they're making decisions around where to move. We're also starting to see actual evidence that people are taking this information and making decisions with it. Or said another way, people are making climate-informed decisions around where to live. And on the best case sort of research study that we've seen so far that's showing this came out of Redfin. There's a partnership with Redfin, MIT, and USC. They looked at our data integrated on the site. Ultimately, half the people were exposed to the data, the other half the people weren't exposed to this data. And after looking at search behaviors following that controlled treatment exposure, they found that folks that were exposed to the data systematically searched for lower risk homes. Interestingly, they weren't searching for low risk homes in different markets. They weren't saying, it's really dangerous in Miami, I'm going to look in Michigan and see where I can find a home. They were looking in the same markets. They wanted to find homes that had relatively less risk, but again, kept them close to family, kept them close to their social networks, allowed them to keep the same job. And by doing so, ultimately what this ended up providing was more evidence of the fact that the way to understand how people are making climate informed decisions is to focus at a high resolution and focus at potentially the census tract level versus county or state level analysis. So we have been taking into a lot of this information and trying to understand the impacts that chronic climate exposure is having on communities, especially through indirect impacts. As I mentioned earlier, we published 4 peer-reviewed papers that helped to support this report that we put out. One is this multi-hazard climate migration model, which allows us to build on our initial POC paper that we ran with flood back in 2023. We've added in at this point heat, we've added in drought, wind, wildfire. All of our hazards are now part of this multi-peril climate migration model. Beyond that, we work to understand what happens to communities when populations change. So it's not just that people leave an area, but the demographic composition and the socioeconomic character of that community changes as populations change. So we're capturing both the absolute number, but also composition changes. And those composition changes in this paper are actually related to things like macroeconomic output, things like GDP, HPI, the socioeconomic character, commercial viability of communities as a way of understanding what are the implications of the changing population. We forecasted out, and I think this is a really important paper, we forecasted out population projections out into the future using the Intergovernmental Panel on Climate Change's SSP pathways, and NASA had already done some scaling of this in collaboration with Matt Howard to bring this data down to the county level. We worked with him to actually bring the data down to the census tract level so that we can understand not only how is climate going to impact future population projections, but how is the social, the economic, the political character of those communities also going to impact future population projections. So it gives us the ability not to look at climate in a vacuum, but to understand it with those larger community characteristics. So as we yeah.
It's so, yeah, I was just going to say, Jeremy, it's so interesting to hear you talk about it, because it's been just listening to you talk. It's been almost a decade now that we've been at work building all these different models, pulling all it together, and now it's the kind of it's almost like these last pieces of the puzzle that you're pulling together allow us to move from what was initially, let's build a flood model to understand exposure to a property, and then let's figure out damage. I'm seeing a lot of questions in the queue come in around like, how do you understand a property's risk? So we go from exposure to how likely is something to impact that structure? How likely is water to be to the building? What is that level of water? How likely is a flame to make it to the building? And then we go past that to then the actual consequences that could happen, the damage calculations of how likely is that structure given the materials to combust? How likely is that home to be damaged if it's 2 feet off the ground, there's a foot of water? Does it have a basement, so the water will go in the basement, or does it not, and it'll be okay? So all of those to the questions around, do you take that into account when you're doing insurance pricing? Do you take that into account in your statistics? Yes, all of that is included, but then now you're doing this one level past that, which is given those things, we're now able to then go one step further on forecasting out these population trends, these actual insurance prices and the macro side versus just the chronic and acute exposure that we have historically. It's so nice to see it all come together, but also just explaining to everyone in the questions, all of these have been built up at the property level, as Jeremy's talking about, to really now unlock these new insights, which have also been years in the making of what you and the team have been building on.
Yeah, that's a really good point, and probably some context setting at the very beginning would have been good on my side, but I think
no, it's great. It's great.
But I think your point's well taken. I mean, we've been building for 8 years now. We started out with hazard models, and we built, it started out with the flood model. We built a wildfire model. We have a great climate science team that now has a hurricane wind model. We built a drought model, a hail model, and ultimately we were focused on understanding how those different exposures impact buildings, and that's direct exposure, damages to the building. That's where we build our AALs from that we talked about earlier that are related to the insurance increases. And then one of the things that we wanted to do to sort of round out our understanding was understand not only what are the direct impacts of climate exposure, but what are in terms of damages to the building, downtime, time to repair, things like that. But what are the indirect impacts? What are the impacts to the larger community? And that's where this research sort of falls into place. So to your point, Matt, it does sort of create kind of that last leg that we've been working on, trying to tie all these things together. For this model in particular, we focused on chronic climate exposure. We ended up looking at more rare events also. Ultimately, we ended up finding out that when you created these expected exposure metrics, things like the 20-year, the 50-year tended to be much more powerful drivers of community change than did things like a 100-year, a 500-year. event. Oftentimes those events, people rebuild from them, they're insured against it. People think about those events like they're not going to happen again because they lived through one of them. Whereas if you start to see the chronic exposure, the persistent exposure over time, we started to see statistical signals associated with population change, which directly impacted our supply and demand impacts, which led to, in our model, market price adjustments. And again, all of these were predicated on historic analysis. And then on the other side, what we ended up using was an asset valuation tool that looks at how higher insurance prices are leading to higher expenses for properties, which essentially decrease the operating budget for homeowners, property owners, for families, and make their way through to reduce property value. We tied all that stuff together to create this reduced property valuation model. We look back at the historic record to understand how changing population impacts the real estate market. This is a traditional supply and demand model. These are actual transactions that were recorded by the county level recorder's offices in both the residential real estate and the commercial real estate spaces. And what we see is that as population increased on the right-hand side of zero from 2000 to 2020, the cost of residential real estate, or the value of residential real estate in the commercial and the residential space, ended up increasing in inflation adjusted dollars. And when we looked at it, everything to the left-hand side, as population decreased, we saw the exact opposite. The pattern in the residential market's a little bit stronger. It's a little more sensitive to population change, but we see the positive and negative patterns associated historically in the data set.
Yeah, and Jeremy, just to that, I think there was a few questions in the chat that I saw that were, do we have this data available for non-residential? And I think in our mind, we always talk about residential all the time, but like, if you could add some color to that. And then before you answer, just to everyone who's putting in questions, we encourage the questions. It's wonderful to see them. There are literally thousands of people on this webinar. So if we're not getting to your questions, we apologize. It's because there's lots of them and they're great. And so we're trying to pick as many as we can to talk, but we'll do our best to answer them for those of you who are curious about whether we're going to answer every question. So Jeremy, commercial real estate, my friends, tell me about it.
We have the data. I mean, we focus this report primarily on the residential market, specifically because we have really good data on homeowners insurance premiums and expectation of how that's changed into the future. So the part of the modeling process was a lot more straightforward. We have the data though for commercial properties, commercial real estate. We have it broken down by industry types. We have real estate, commercial office, industrial, hospitality. All of those different industry types are captured in our data set. We do model damages. We model downtime. We model the indirect impacts of the changing community, whether it be population migration or GDP, HPI, whatever those outcomes may be. So we are modeling those indicators for the real estate market at large, and can break it down by residential and commercial. So this is the tool that we used for the commercial or for the insurance impact. Essentially, we use what's called an annual owner equivalent rent that comes from the CPI, where we can understand in any given market for any given single family home that probably isn't for rent, is probably owned by a homeowner, what's the equivalent rent that you could expect to get in that market if you own the home. And then we added to that the annual operating costs, things like maintenance, repairs, property taxes, insurance cost. Together, that gives you an operating income, the annual rents versus, or minus actually, the operating cost. If you divide that by a cap rate, you get some kind of an asset value. This is a traditional tool that's been used in the asset valuation world or by institutional investors to understand how asset value changes. Ultimately, what we've done is simply layered in an additional insurance cost into that cost of home ownership, which reduces that net operating income at the property. This is just here to illustrate the point. Ultimately, we ended up dividing that by the same cap rate that we used in this equation to create a new asset value. You could add on an additional risk premium if you were using the metric, but this gave us the ability then to understand how additional cost of home ownership impacts the asset value. So coupled with the supply and demand trends that we saw before, we were able to take actual historic information and start to think about how that may impact future property value impacts. And so places that have experienced this in the past, especially in terms of acute exposure, are the kind of places where we see these patterns most acutely. So here, this is Paradise, California. It was impacted by the Camp Fire. In 2018, you can see the insurance costs, the population, and the property value metrics. In 2023, we're up almost 40% on insurance costs, we're down almost 70% on population, and we're down almost 40% in property value. And a lot of that has to do now with the desirability of the area. There's just not as many people in the area. The cost of homeownership is going up. And you can see that people are rebuilding in the area, but the market itself just is nowhere near what it was back in 2018. So we ended up running all of our census tracts through the model historically to understand how to sort of classify different census tracts, and we ended up with 5 different categories. One is a climate abandonment area. These are areas that are significantly impacted by climate risk and have a statistical relationship between that climate risk and negative population change. So we're actually seeing population loss in these areas. We have risky growth areas. These are places that have significant climate risk, but continue to grow in terms of population. These are your Miamis, your Houstons, your LAs, the places that we know of that have climate risk. They're covered in the media, but they continue to grow due to the economic opportunities in the area. And then really interesting to us were these tipping point areas. These are places that start off as risky growth areas, but at some point during the time series, that the disamenity of climate exposure increases to the point to where it outweighs the amenities of the economic opportunities in the community. So these are really our primary groupings that we're interested in the report. We also track climate resilient areas and areas that just are declining due to just economic decline in the area. Again, the narrative of sort of the Rust Belt to the Sun Belt kind of emerges when you think about those areas. So as we started to track these as national trends and projected them out into the future with our climate corrected exposure data, ultimately what we ended up seeing was that the risky growth areas are actually projected to grow faster than any other group. I mean, these are the areas we know have a lot of climate risk, but the economic, the social, the political character of the communities, the amenities in the communities are still pulling people into those areas. And when you think about the relationship between climate exposure and pop change, it's important to think about that larger macroeconomic context to know why people may be pulled into a community or pushed out of a community. So those are still the fastest growing communities. You can see our tipping point communities have the most nonlinear trend in our data, increasing in population out to about 2040 or so on average, and then we start to see declines in population from that group. The other thing that's really interesting is that the risky growth group also see the biggest impacts in insurance moving into the future, which means that they're going to see the biggest increases in exposure, even though we're seeing the largest increases in population in those areas. So these are the areas where the macroeconomic environment of the community is drawing people in spite of the climate risk. We only go out 30 years. A lot of these places, I suspect, if you model out further than 30 years, you start to see tipping points, maybe out to 70 years, 75 years, and so forth. So we coupled what we're calling here the market impact or the population change impact on property value and the insurance impact on property value. In climate abandonment areas, on average, we saw about a 6.2% decrease in property value over the next 30 years. Interestingly, the insurance effect is more than double the effect of population change. So it's like cost of home ownership that's the biggest driver of population decrease or a property value decrease, sorry. Tipping points have an interesting pattern. You can see increasing property value from the increasing population. Ultimately, we see it decrease at the end of the time series, but we see persistent decreases in property value from the increases in insurance costs. Risky growth areas, we're seeing increases in the property value due to the increase in population, but we actually see decreases due to the property value impact. And then for climate resilient areas, really positive impacts from growing population relatively minor impact from increasing insurance, where we don't expect to see a tremendous impact from climate, at least, on insurance costs into the future in these communities. Again, we extended that to some of the macroeconomic indicators, things like HPI, GDP. We're able to model then the impacts on GDP, for instance, in the risky growth areas continues to increase. These are still going to be places that draw people in. They're going to be places that draw investment in to those communities. Tipping point areas is a relatively flat impact on GDP. Climate abandonment areas, we can see a negative impact. But it gives us the ability then to think about individual properties as property value, and then the larger macroeconomic context when we start to model these things out. Just a couple more slides here. I think one thing that's really important is to highlight again the fact that these patterns operate sub-county, so they happen within markets as opposed to across markets. So here we're actually showing that there, even here, this is an example in Tampa. We're actually showing that some places show property value growth over this time period while others see property value loss. And it really is the combination of those social, the economic, the political characteristics, and the climate hazards and climate exposure in the space. And some places are just more resistant given the amenities in the area than other parts of the community. We have our top 10 list laid out. Again, we walk through these in the report. I'd encourage everybody to sort of download the report and look at the actual tables there. I'll call out a couple of really interesting things. First, our top 10 counties by property value loss are primarily in Florida. We can actually see market increases in property value. We still expect in our population models for people to continue to move to Florida. It's not a huge impact on property value, but they're positive, which means that our models are showing people's continuing to move into the area, population continuing to grow, maybe at a slower rate, but continuing to grow. But the insurance impacts in this case are what are driving the total property value impacts. You can see some of the climate resilient areas, Dane County, where Madison, Wisconsin is, Franklin County around Columbus, Ohio, places where the market impact is predicting to see a lot of population growth with relatively minor insurance impacts. Same thing for GDP. We can see the biggest losers in terms of our model in terms of GDP, the biggest winners. The winners was really interesting in terms of GDP gains. A lot of them are in Texas. And again, it's important to note that we're projecting out our populations based on SSP trajectories. The SSP trajectory, SSP2 is particularly what we're presenting out here. We do have SSP1 and SSP5 available as well, but in SSP2, sort of a business as usual movement towards reducing carbon concentrations in the air, and what are the socioeconomic pathways that get us to that place. A lot of that means we're still investing heavily in oil and gas, and we're still investing heavily in industry that maybe doesn't explicitly counter the carbon concentrations that we're working towards reducing. But what that means is continued investment opportunities, growth opportunities, employment opportunities in places like Texas. So we start to see that macroeconomic context emerge in these numbers as well. And sort of the big takeaway over the next 30 years, our models show that America will lose about 1.47 trillion in property value tied explicitly to the climate risk that we're modeling out through indirect impacts of population change and insurance increases. Other areas that are more resilient to that climate exposure will gain 244 billion. Again, you should think about this as lost property value or lost appreciation due explicitly to the climate exposure. So Matt, I think you want to talk a little bit about our enterprise suite.
Yeah, that sounds great, Jeremy. And one question that came up a few times, if you go back one slide there, is just how to think about that in context of the total real estate market being worth 45 trillion or whatever you had on that opening slide. So we see that value depreciation. Is that a 0.01, like a basis point off of this, or is this something that is massively significant that everyone should take into account, and it's so critical? Can you give us some context into what these numbers actually mean?
Yeah, and so it does represent about 3% or so of the market, given the numbers that we presented earlier. I think one of the things that's really important to point out is that this is not inflation adjusted. We're not inflation adjusting our market expectations for property value into the future. We're really trying to isolate the impact that climate is having. And ultimately what this means is that everything else being equal, on top of that, we're likely to see 1.47 trillion in lost appreciation for areas that are exposed to heavy climate risk, but also have a less than resilient sort of macroeconomic structure. So it is sort of the combination of those two things, but it ends up ultimately being, 3% of what today is our residential real estate value across the country.
Right. Okay. Well, with that, why don't I take over here, Jeremy, sharing the screen, and a lot of the questions that we typically get around these models or what we're doing is, well, that's great. That's all this data. How in the world are we possibly going to actually turn this into business decisions or actionable insights? And really, that's why we've created the First Street Enterprise Suite. And so I will just bring up a property overall to show you where what does this look like from not just a report and data itself, but how do we actually turn this into actionable insights? So for this property that I've pulled up in California, you can actually see all of this type of information that Jeremy's talking about. So across all of the perils that we have, what are the general scores if that's applicable? What is the exposure that we would see? The red colors being you need to be concerned about this, there is exposure or there is damage, or there's low risk and it's not something that is as concerning. I obviously pulled up a property that has a little bit more risk than normal, just so that we can illustrate the point. But then this damage analysis, could there be potential damage to the structure? And if so, what is that in potential insurance increase? Along with what are the building characteristics? Is this home a single family residential home? When was it built? What is that square footage? The material? Does it have a basement? All those things that we can then turn into what are these kind of not only exposure estimates, but damage estimates. So using our maps, our hazard layers, all those different things, we can then look at what is the exposure to a property from flood, from wind, from wildfire, from hail, from extreme heat and drought and air quality. You can change the maps to look at the current year's risk where it's obviously showing flooding for this property, but change the likelihood so that we aren't looking at a 1 in 100. What does a 1 in 500 look like? We can expand it to do a full screen maps and look around the community. We can look at cumulative depth to the structure overall, but what does 2 feet of flooding look like versus an inch of flooding? And then what does it look like under different probabilities? So we wouldn't expect water to the building every 5 years, which is a 20% annual likelihood. We wouldn't expect it in a more rare 1 in 20 year event, but that 1 in 100 event is when you actually see significant flooding to this property. And then with all of that information, we can then run damage estimates. So like we were just talking about, there's no damage in those initial return periods, as we call those probabilities. But then once you see that 5 feet of water, that's when you start to see those damages, or that's when you say, how long would it take to fix this building, to fix this home, to get it back to an operational capacity after such a horrific event? So you can do that for flooding, or we can look at wildfire. How likely is the structure to be destroyed? There was a lot of wildfire risk in this for this building. What is that likelihood, that cumulative likelihood of being this building burning down and being destroyed? What is that business interruption? Or if you're looking at it from a business perspective, what is that net operating income loss? But then really the last piece here is what Jeremy's talking about today. So how do we then take not just the exposure, not just the damage, but then we can look at the macroeconomic impact. So if we're looking at wildfire, average annualized loss, that thing that would turn into that insurance estimate, or those wind damages or the hail damages, how are those added together into homeowners costs? And then we see flood here, that blue line. That's a significant amount at $8,000 a year in average annualized losses that you would then have to get a flood policy for. So combined, what are all those AALs? How are we seeing them move into the future? under the different SSPs, how do they change? But then really, what does this manifest in the sense of an insurance policy? So we have this idea of the real insurance premiums where a lot of questions on the webinar, people were asking about, well, what is the current cost of insurance? And does that include the ability for insurance companies to charge the real rate, or are these the suppressed rates? So we have both in our data sets. We have what the current premium is for the property in that state, given the insurance commissioner's approved rate filing tables. So we know from the rate filing tables how much premium, given this building characteristic, square footage, where it is, all of those different elements, what they would be charged as a premium. And then we say, well, what is that actual adjusted premium given its risk? What is that delta? For this specific property, it's immense. And so when they are eventually allowed to charge that actuarially sound premium, as Jeremy was talking about earlier on in our presentation, and we were seeing, well, they can't actually make up for the losses. In the most extreme cases for some of these properties, as he was highlighting, there's a big delta. The current premium is $2.8 thousand, and really it's $15,000 on an AAL basis. So that delta has to be made up. And when you make that up, you will lose significant property value. So what is the value change expected for this specific structure today, just for that adjustment? And then how does it increase in the future as climate continues to increase that risk and premiums go up? And what you'll notice right away is that shock, that initial price correction, because it has been built up for so long and we haven't actually seen it manifest to these properties, is the biggest chunk. So we're not sure when this will happen. When will we allow insurance companies to charge an actuarially sound price? But when they do, that's what our NOI calculations, that net operating income equation would tell us would be the impact to this property's value. And then how it would decrease over time, those what seem smaller increases once you have that initial adjustment over the next 30 years are from the increasing average annualized losses from climate change. So you have that shock and then the continual gradual increase. But those are then offset because what we're seeing from the population change, as Jeremy was talking about, that demographic shift in this area, we then see over the next 5 years, the supply and demand, even though that risk exists for the property in California, people are still expected to move into there. So that's actually creating more demand for the properties, driving properties up. So there's an initial bump in 5 years, and then we see in 15 and 20 years, there's another bump and slowly going out to another $40,000 in increased value over time that you would get from that increased desirability in the area. But the risk is there and it's being offset by those losses in insurance. So what does this mean overall for this property? Is that you see a large shock, but then with those insurance or the population growing over time, the property value will rebound and start to increase back. So still a net loss from what the value is today, but something that will improve over time. So a very interesting view on how we can do this for properties. And then we can pull in things like DTI, so GDP, HPI, and what is that forecasted to change? And then we're able to look at population changes. So what do we expect the population to be in 5 years, 10 years? What is that growth? What's the median income, the median age? What is the economic indicators that we're talking about here over time? What are those demographic changes that we would expect over time? And really complete the picture for this property's risk. So not just the exposure, not just the damage, but the full macroeconomic view of risk overall that can be viewed for one individual property, whether that's commercial real estate, residential real estate, multifamily, whatever it might be. And what's really interesting about not that we're able to have this at the property level means that we can look at this from a portfolio perspective. So what I uploaded today was everyone's favorite Waffle House, all the Waffle House locations across the country. And so we can aggregate all of this risk, not just at the property level, but then for a portfolio. And we can look at risk across all of these assets across the country and start to filter across which ones have the highest level of risk. We can look at it from which state we want to look at, or whether it's there's only one in California, but we bring in Alabama and there's a bunch more, and we can filter across the highest levels of risk. We can look at that scenario analysis across all of these properties together, so not individually, but collectively. And then lastly, pulling in, what does this mean overall for your portfolio of properties, given the macroeconomic variables Jeremy talked about today? So what does insurance do to this commercial real estate portfolio? Well, over the next 5 years, we would expect it to decrease the value of all of these properties by about $500,000. But then we see a large increase in the population change overall, given the location of these structures. So these are the types of things that we're able to do with the First Street Enterprise Suite that really bring all of this research to life. So it isn't in the abstract, it's very much something that's tangible down to a property level, because at the end of the day, as we always say at First Street, is a property is only as valuable and desirable as the neighborhood, the city, the county that's a part of. So what is the risk to that structure? What are the impacts of the broader economic environment on that structure, so that you can make the right investments, make the right decisions, and understand all the risks that may be present for that individual structure or your portfolio of structures.
Yeah, and Matt, I'll add, I think it's really good to add, the walkthrough and look at the property level, because we presented so many high level kind of national numbers in the report. The fact though is that it's a within market story. The impact, the 1.47 trillion, whether it's 3% of the property value in the residential market, and it feels to some people like a small number, to other people may feel like a large number. There are going to be communities where it's a much larger impact on their property values, and then there's going to be places that are going to see significant increases. So I think it is worth pointing out that all of this starts at the property level, and there's a lot of variation that we're hiding when we look just at the national numbers.
With that, Jeremy, some things that I know some people have asked and I've been prompted on. One, all of this data is available for the United States. We have all of it in our property, and we're expanding. We recently raised $46 million as a company to then allow us to build global models. So those global models are coming in the first half of 2025. We're really excited about it. If you're interested in learning more about that and our timelines, all those things we just showed you, from insurance, migration, all of those are part of those global models. So for any property in the world, we'll be able to look at that, or collectively. So please reach out, firststreet.org, or you can send me an email. I'm Matthew@firststreet.org. And then the second thing, Jeremy, I think if you wouldn't mind pulling up the slides, because I lost them on my screen from demoing, but is next week, First Street is actually having our first conference. We're calling it Forecast. We have about 300 people from the climate risk financial modeling community coming together to really talk about the overall risks as we see it, from not just the exposure and the damage, but exactly what we touched on today in this webinar. So we have a great lineup, keynotes from John Kerry and Sarah Bloom Raskin to the top scientists in the world, really grounding us in what we can model or can't model today. We have the top economists talking about the insurance impacts, just as we discussed. And then we move on to the largest banks, talking about how they are actually managing these risks. And then we move on to asset owners and asset managers, to then talk about how they're actually thinking about this from a commercial real estate or an investment perspective. So Forecast, an amazing event. You can register interest with us. If you can go to firststreet.org and you'll be able to find it. But if you're interested in coming, please let us know. And we look forward to seeing some of the people on this webinar there. And Jeremy will be giving a bit of a condensed version of this at that conference as well. So I think that's it from us at First Street. If there's any questions at all, please reach out. You can go to firststreet.org and you can request a demo. You can look at inquiries overall from our forums there. And overall, I think Molly just dropped in the actual link for where you can register your interest. So if you click on that link at the bottom, you'll see it. But thank you so much for staying on for our webinar today, for your interest in First Street, and we hope to hear from you soon. Thanks again, Dr. Porter, for your time, and we'll look forward to you at the next webinar.
Yeah, thanks everybody.
See you later.